Well, let's look at these disclosures and implications for analysis. And this is the LIFO Reserve. And this is, I want to go over this with you because, again, I think as I mentioned on Friday, you have to think about whether it is logical that General Motors and, let's say, Ford use the LIFO basis, whereas Honda is using FIFO, and how do you compare them? So what we've decided to do in terms of comparability, which is one of the qualities of accounting information that makes it useful. So right now, if you were doing an analysis of the auto industry, and you were trying to compare General Motors, Ford, and Honda, you couldn't compare them, especially on the inventory levels, because the US companies are using first in, first out, last in, first out, LIFO. The international companies are using FIFO or average cost. They're probably using FIFO. So in order to help the user, in order to help the analyst, you as accountants are required, and remember, we said that you have to provide information that allow users to make decisions. So we need to come up with a way to make the statements comparable. And what we do is we disclose what is known as the LIFO Reserve. Some people call it the adjustment to LIFO, some people call it the LIFO credit. Whatever you see in the homework, and that's why using live financial statements is extremely important, because what you don't want to do is go out into the field and say, that's wrong, it's not the LIFO credit, it's LIFO reserve. No, it's just a different term, so that the LIFO reserve or the LIFO credit is the balance sheet effect. So you can always convert the LIFO inventory to FIFO by adding the LIFO reserve. The LIFO reserve is the cumulative effect. That is the sum of all of the LIFO-FIFO differences over time. So when you look at the homework, and they're asking you for the cumulative effect, that's the balance in the reserve itself. The change in the reserve, sometimes known as the specific effect or the LIFO effect, that is the income statement impact. That's the income statement effect. So that if we, let me give you an example. Let's put some numbers up here. Say it's year one, and let's just go through a cost of goods sold calculation. Let's see, I made up some numbers, I think. Yes, I did. All right, so you start the year off with 100 units, $100. I'll get to the valuation in a second. You buy 1,000. You have 1,100 available, and the ending inventory is 200. And cost of goods sold is 900. And that's the FIFO basis. Now we take the same year on the LIFO. So the inventory is at 80 under LIFO. You purchased 1,000. The goods available are 1080. And the ending inventory under LIFO is 160. And as a result, cost of goods sold is 920, which you would want under LIFO. You want to have a higher cost of goods sold, correct? For the tax purposes. Now, if, get a different color so I can see it a little bit better. So if you are a financial analyst, you're only seeing the LIFO numbers. But what I can do to help you in a footnote, now again, you don't see the FIFO numbers. So now you're General Motors and you are Ford and you're using LIFO. And in your financial statements, in the footnotes, you get the LIFO reserve. And again, you can't hold me to that terminology. That could be LIFO credit. That could be the adjustment to LIFO. That could be, the difference, whatever they call it. The LIFO reserve is 20. And if I disclose the LIFO reserve, what happens? The analyst adds the reserve to the LIFO inventory to get the FIFO inventory. Simple as that. Now, again, you're not seeing this. That's not available. And by the way, the purchases are the same. I mean, your vendor doesn't say to you, what inventory method are you using that'll determine what your purchase is going to be priced at? No, you all buy the same thing. And then, of course, the ending inventory, the LIFO reserve is the $40, the difference between LIFO and FIFO, add those up, and now the financial analyst can kind of see into this unknown FIFO world and find out what the inventory would have been. And they could recalculate ratios, like the current ratio, which I mentioned is understated, current assets over current liabilities, understated under LIFO. The turnover ratio is overstated, right? Cost of goods sold divided by average inventory. So this allows you to make those conversions, allows you to make the conversions. Now, that is the LIFO reserve itself is the cumulative effect. This is the cumulative. Now, what you may not be seeing in the textbook, or what you may not be seeing in the homework problems, is the change in the LIFO reserve. What did the LIFO reserve do? It went from 20 to 40, so it increased by 20. So that means you're getting what you want with LIFO, correct? You're getting higher prices, quantities are going up, you're getting tax advantages. This is the specific year effect. Not cumulative specific. So, yes?
I'm sorry, how did we get 40?
It's the difference between,
Oh, gotcha. Thank you.
yeah, it's always the difference between the two. But I'm saying in the footnote, you're not going to see the 100. You're only going to see the 20.
Okay.
And sometimes they give you the FIFO sometimes, I have to say. It really depends. Now, here's the question. Can anyone see how I could adjust the cost of goods sold? What's the cost of goods sold under LIFO? It's $9.20. If the reserve went up by 20, that means what should the cost of goods sold be under FIFO? It's got to be lower, and it's going to be lower by 20. So that's why when you take the LIFO COGS and subtract out the change in the reserve, you get the FIFO cost of goods sold. The FIFO cost of goods sold is equal to the LIFO COGS minus the increase in that reserve. And based on those disclosures, that's how you're capable of converting a LIFO company back to FIFO. And until LIFO goes away, this is going to be a major issue for us. It's always going to be a major issue for corporations that are using LIFO in the United States. Because it's senseless for General Motors to use LIFO. I mean, they certainly don't sell their newest cars first and leave the 2016s in stock when the 2017s are coming out. That's like saying, oh, 2017s get released in September, but we're going to sell those first and leave the 2016s in inventory. Not going to happen. But the price allocation, the cost allocation, is based on LIFO in order to gain tax advantage. So that's the key. So let's make sure, this was the last issue that I'm going to mention in this chapter, but let's make sure that, unless you have questions on the ratios, but let's make sure you have a good feel for how that reserve is going to be used. You're going to be given enough information, or you as an accountant will be given the analyst enough information so that they can convert LIFO companies back to FIFO. The reserve, the cumulative effect is balance sheet, add the reserve to the inventory to get the LIFO, to get the FIFO inventory. The change in the reserve would impact the cost of goods sold. If the reserve goes up, you're getting what you want out of LIFO. What are you getting? Higher prices, quantities are going up, the reserve is growing, that means you're getting more tax benefit. Multiply that by 35%, that's the specific benefit for that year. You multiply the reserve itself by 35%, that's the cumulative benefit that you're getting over the life of this, the use of this method. All right, so what I want you to do, again, you have time to do the assignments. Think about that, but that's it's not extremely difficult, but sometimes it's hard to wrap your mind around the idea that by a simple disclosure, you can make pretty radical conversion.
So we're never going to see the LIFO reserve decrease from January to December. If not, they would be doing FIFO?
Yeah, well, yeah, no, no, you bring up an excellent question. If the reserve goes down, you're not going to switch to FIFO, but you're actually getting an adverse effect. What will happen if the reserve goes down, it means, let's say this reserve dropped by 20, that means the FIFO COGS would have been 940. It would have been higher, which is what you don't want if you're using LIFO. Now, do reserves shrink? That's the LIFO liquidation, that's the problem. If you liquidate layers, you're going to be paying more tax.
Makes sense.
Yeah. So companies might, one way to avoid the liquidation is just to keep buying more inventory. And remember the question you had before, or the point you made before, and I said, well, no, you don't want to do that because you don't want to pile inventory up if you can't sell it.
Right. In this case,
Yeah, so if the reserve is going up, you're getting what you want. If the reserve is going up, you're getting what you want. Okay? All right, so that is all I want to do here. I know you got the ratio. Oh, no, wait, I want to do one more thing, excuse me. Something else to show you. But anything else on the LIFO reserve? Okay, so I think that covers everything for the assignments. Now, what I want to do, one last point. And let me just run through. And these, by the way, these are all the effects of LIFO, FIFO, just a summary about tax benefits. Okay, here we go. Inventory errors. I just wanted, the book doesn't bring this up, so I took this from another book, or another set of notes I had. One of the things you have to realize is that inventory and profit are correlated. Ending inventory and profit will be correlated. So for example, and here's one of the times that you might want to fall back on the accounting equation. If there's a mistake, and by the way, this is not necessarily a mistake, if you use an inventory method that increases inventory, like FIFO, if you overstate or have a higher inventory, you're going to have a higher profit. And you can see it right here, because, and can I erase this? Anyone else need that for anything? The higher the ending inventory, the lower the cost of goods sold, and profit goes up. So let's say, for example, I make a mistake here, and I make the inventory, let's say, 300. What happens to cost of goods sold? The higher the ending inventory, what happens to COGS now? How much would it be? 1,100 minus 300 is going to be 8. So the higher the ending inventory, the higher your profit. If the inventory is lower, as it is here, it's going to give you a higher cost of goods sold and lower profit. That's what you're seeing here. That if you understate inventory, you overstate COGS, understates gross profit, it understates net income. So basically, there's a direct relationship between ending inventory and profit. And you can see it on the equation. The higher the ending inventory, the higher the profit. Now, that is going to be inverse with beginning inventory. Beginning inventory is just the opposite. Beginning inventory is going to be directly related to COGS. And I'm going to show you that in a minute. So this is something you can always look at. And the best way to see that is, let me give you an example. So the best way to see that is through this illustration. So if you're looking up at the screen, you'll see that if I do this correctly, I have beginning inventory of 100, I've got purchases of 3, I've got 400 available, with an ending inventory of 250, cost of goods sold is 150. Another critical point, just to make sure that this is kept in mind constantly, that the ending inventory of 1 year becomes the beginning inventory of the next. And next year, beginning inventory is 250, purchases are 300, goods available are 550, ending inventory is 450, and COGS is 100. That is correct. That is the correct reporting. Let's assume you make a mistake and you overstate your ending inventory by 280. What will happen? Instead of having a cost of goods sold of 150, you've got a cost of goods sold of 120. The higher the ending inventory, the higher the level of profit, because you lower the cost of goods sold. You have lower cost of goods sold. So you overstate profit by 30. But here's the important point, and this does not make it correct, this does not make the situation positive, it doesn't make it any better. But inventory errors reverse themselves out after 2 cycles. Because next year, the beginning inventory is overstated by 30, goods available are overstated by 30, so instead of being 550, they're 580, and even if the ending inventory is correct, the cost of goods sold is overstated. So the higher the beginning inventory, the higher the cost of goods sold. So instead of having 100, you've got 130, and profit is reduced. So inventory errors reduce, or I should say, reverse themselves out after 2 accounting periods. The higher the ending inventory, the higher the profit. The higher the beginning inventory, the lower the profit. So ending inventory is directly related to profitability. Beginning inventory is inversely related in terms of having those errors. All right, so that's something I just wanted to make sure, although the book does not show that, something I wanted to be sure that you see. All right. Any questions on that? I mean, that's just a fact. I don't want to say it's like a kind of a thing you got to memorize, but it's important to note the impact of inventory errors, or not even an error, the method, right? FIFO gives you higher inventory, lower cost of goods sold, higher profit.